If you run a small shop, café, takeaway, barber shop, convenience store, beauty salon, or any high street business in the UK, this video is for you.
Because every year I see the same tax mistakes repeated, not because business owners are careless, but because no one explained the rules clearly.
And those mistakes can quietly cost thousands of pounds in penalties, overpaid tax, or unnecessary stress with HMRC.
So today, I'm going to walk you through 5 of the most common tax mistakes small shops make in the UK and how to avoid them. Let's start with the first one.
The VAT threshold mistake. Right now, the VAT registration threshold in the UK is £90,000 of taxable turnover. That's not profit, that's turnover, total sales.
Many small shop owners track their bank balance. They track what's left at the end of the month. But they don't properly track rolling 12-month turnover, and that's where the problem begins.
Because VAT registration is triggered when your turnover exceeds £90,000 in any rolling 12-month period, not by calendar year and not by tax year. So you could cross the threshold without even realizing it.
If you register late, HMRC can backdate your registration. That means you may owe VAT on sales you've already made, even if you didn't charge customers VAT at the time. That becomes a direct cost to you.
I've seen small shops suddenly facing 5-figure VAT bills simply because turnover wasn't monitored correctly. So mistake number 1, not monitoring the VAT threshold properly.
Now let's move to mistake number 2, the sole trader versus limited company misunderstanding. Many small businesses start as sole traders. It's simple, it's quick, it works in the early stages.
But as profits increase, staying as a sole trader can become expensive. Why? Because sole traders pay income tax and Class 4 national insurance on profits. Limited companies pay corporation tax on profits, and directors can structure income through salary and dividends.
For some small shops, especially those generating steady profits above a certain level, incorporating can reduce overall tax. But the key word here is for some, not everyone.
Incorporating too early can create unnecessary admin and costs. Incorporating too late can mean years of overpaying tax. So mistake number 2, never reviewing your business structure as your shop grows.
Now, mistake number 3, poor record keeping, especially in cash businesses. Many high street businesses still take a mixture of cash and card payments, barbers, takeaways, car washes, convenience stores.
HMRC knows this. And poor record keeping in cash businesses is one of the biggest Enquiry triggers. If your declared income doesn't align with industry averages, card receipts, or stock purchases, it raises questions.
And if you can't support your figures with proper records, you're exposed. Making tax digital is coming for more businesses from 2026 onwards. Digital record keeping is no longer optional in the long term.
So mistake number 3, treating bookkeeping as an afterthought. It's not just about filing a tax return. It's about being able to defend your numbers if asked.
Now mistake number 4, payroll and RTI submissions. Many small shops employ 1 or 2 staff, sometimes family members, sometimes part-time workers. Payroll seems simple.
But HMRC requires real-time information submissions, known as RTI, every time you pay employees. If you miss submissions, if figures don't match, if pay isn't paid on time, penalties can follow.
And once HMRC systems flag your business, you may find compliance becomes stricter. I've seen businesses that thought they were paying staff correctly, only to discover months later that submissions were never properly filed.
So mistake number 4, assuming payroll is straightforward without checking compliance. Now the 5th mistake, claiming the wrong expenses, or not claiming enough.
Some small shop owners are too aggressive. They claim personal expenses through the business. That creates risk. Others are too conservative. They don't claim legitimate expenses they are entitled to. That means they overpay tax every year.
Common areas of confusion include repairs versus improvements, use of home as office, vehicle expenses, equipment purchases, phone and internet costs.
Understanding what is allowable under UK tax rules makes a real difference. So mistake number 5, not reviewing expenses properly each year.
Now let's step back for a moment. Notice something about these 5 mistakes. None of them are dramatic. None of them involve fraud. They are everyday misunderstandings. And that's why they are so common.
Small shop owners are focused on Stock, staff, customers, rent, energy bills. They are not focused on tax legislation, and they shouldn't have to be. But ignoring tax doesn't make it disappear.
So if you run a small shop or high street business, ask yourself, are you monitoring your VAT threshold properly? Have you reviewed whether sole trader or limited company is right for you? Are your records strong enough to withstand an HMRC inquiry? Is your payroll fully compliant with RTI requirements? Are you claiming the correct allowable expenses?
If even one of those areas feels uncertain, it's worth reviewing. Because small tax mistakes rarely stay small, they compound.
If you'd like clarity on your business structure, VAT position, payroll compliance, or tax setup, you can get in touch. We work with UK landlords and small business owners across the country. You can email us at info@weyourtaxhelp.co.uk. If you found this useful, subscribe for more practical UK tax guidance. And I'll see you in the next video.